Insure your income. Insure your outcomes. Invest to rest with purpose. IQWealth.com.
All right, when we're looking at annuities, one of my recommendations is don't confuse the categories. There are 4 categories of annuities: immediate, variable, fixed, and fixed index. They all can provide you with a lifetime income if you want one. That's why they're called annuities. The word annuity comes from a Latin term annua, which means an annual income, pretty much for life. That's the whole idea. But an immediate annuity is very different from a variable or a fixed index. The immediate annuity, of course, is just giving you that immediate income, and that's all you get. Now, because it's all you get, sometimes that income will be a little higher, but what you have to give up is complete access to your principal. Therefore, people look more at variable annuities, fixed or fixed index. If you're looking at a variable annuity, don't forget about all those fees, because in that category of annuity, you're placing your capital into the stock market directly, and you're banking on the market making good money over the next 3, 5, or 10 years. Otherwise, you have no business going into a variable annuity. Now, I don't know what you're thinking about, where you think the market is going to go over the next 3, 5, and 10 years. But let's take a look at what John Bogle has to say, founder of Vanguard, who can still use a calculator really, really well. He says the stock market will be doing well to make 4% over the next 10 years. Many variable annuities have fees totaling 4%, 1.5% rider fee, 1.5% mortality fee, and then 1% to manage the mutual funds, up to 4% in a hurry. And if all you're going to make is 4, you're really kind of maybe kidding yourself with a variable annuity. That's up to you. The fixed annuity right now, the interest rates are so low that in that category, this really isn't the best time to be looking at a fixed annuity, because interest rates are only in the 2% or 2.2% range. The category that might have the most promise, if you're someone looking for moderate gains, a reasonable return, yet with income features that allow you to get that lifetime income without having to annuitize or turn it into an immediate annuity. That's a fixed index annuity with a lifetime guarantee withdrawal benefit rider. That combination, some people refer to it as a hybrid. It's just a nickname. It's a fixed index annuity with a income rider. So those are your 4 categories. To understand annuities, try to keep it simple and don't confuse those categories. So my next don't is don't confuse yourself with the facts. And how could you be confused with the facts? Well, the question gets to be is, what's a fact, really? When you're on the internet, you'll see all types of opinions. You'll see people even saying they're giving their unbiased view of annuities. Typically what I found, when someone says it's an unbiased view, extremely biased. You have to be very careful. The fact of the matter is, and there we go with the word fact again, is that you can learn a fact about an annuity that may be true of an immediate annuity, or may be true of a variable annuity, but is not true about a fixed index annuity, and vice versa. Now, I hope I'm not confusing you with that terminology, but that shows you how simple it can be to get confused. Make sure you don't confuse the categories. Understand that if you're talking about an annuity that ties up your money and you no longer have access to, what type of annuity would that be? Well, that would be an immediate annuity where you give your principal to the insurance company in exchange for payments. So if someone says your money's all tied up and you can't get it, what kind of annuity are we talking about? Immediate. Now someone says there's so many fees. Fixed and fixed index annuities are available with 0 fees, none. 100% of your money goes to work right away without any deductions, and there are no annual fees whatsoever. The type of annuity they're talking about when we're talking about fees, variable annuities, and there are plenty of those. There can be a 1 to 1.5% mortality fee, which is a life insurance fee. There can be a 1 to 1.5% income rider fee. Now we're up to 3%, and then you have all the mutual funds inside of the annuity, the variable annuity. Now we're up to 4%. So you can see that if someone is saying there are a lot of fees with annuities, like Ken Fisher, there's a lot of fees with annuities. If you read into Ken's literature, he's talking about variable annuities. He's right. There are 3 to 4% annual fees with variable annuities. What I recommend is start to learn more of the facts about keeping your money safe and your income long. That's what you go to an annuity for. So don't confuse yourself with the facts. Remember the purpose of your money. If it's to simplify your life, lower your costs, lower your risks, and increase your income, learn the facts about how a fixed index annuity with an income rider works, first and foremost, and then understand this fact. There are over 600 of them to compare. So compare with someone who does have a fiduciary duty, someone who is looking out for you, and has a system of helping you compare and doesn't just say, I've got the perfect annuity for you. Find out what the facts are and work with someone who's willing to share those and help you learn. So we're going through the 5 annuity don'ts, and one of the don'ts is don't disinherit your heirs by choosing the wrong annuity. And how you could disinherit your heirs is with what is known as an immediate annuity. AARP magazine has New York Life immediate annuities for sale. And they offer a rate of income that might be 6 or 7 or 8%, even if you're a little older. But the issue is that's not an interest rate. That is going to be an income payment that requires that you give up access to your money. And the highest income you can get from an immediate annuity would be on a life annuity, life only, meaning you buy the annuity, and if you don't make it out of the parking lot, your heirs would get nothing. Most people don't buy those annuities. There is an application for them, perhaps if it's funding a life insurance policy, but by and large, most people would get a life annuity with a 10-year, 15-year, or 20-year period certain. Once you get to a life annuity with a 15 or 20-year period certain, you might as well go and get a deferred annuity with an income rider. That way, when you pass away, whatever you don't spend out of that deferred annuity passes 100% to your heirs without any surrender charges. That's what I'd recommend. There is a lot of misinformation on the internet about annuities. Some of it embellishes too much, makes annuities sound better than they are. Other types of information you'll receive, and I'd say most of it, is how this person hates annuities and you should too. You'll hear from sources that, like journalists, that you can tell if you really read between the lines, they haven't really done a lot of research. So don't believe everything you hear when you're talking to a journalist or someone who has no interest in annuities. They're a stockbroker or a money manager, and they would lose money if you took money from them and put it into an annuity. So you're not going to hear anything good there. If an annuity has a place in your portfolio, it's because it's going to satisfy a need that you have. And that need might be to stop worrying about the income aspects of your retirement. If you're spending $100,000 a year right now, and with Social Security and pensions when you retire, you'll only have $80,000 a year coming in. Well, you've got to fill in that $20,000 a year gap. Couldn't hurt to go 25 actually, because if you are spending $100,000 a year right now and you live another 30 years, that's going to be $3 million. That money's got to come from somewhere. So the fact is, if you buy into an internet idea of that you're going to earn 8 or 10% a year for sure on stocks over the next 5, 10, or 20 years, that's a guess. That's a hope-so plan. With an annuity, you've got a no-so plan. You know what your income can be, and you could even earn a decent rate of return on your principal at the same time. The main thing is that income will never run out. And when you're talking to somebody who is saying that they have unbiased or objective opinions on annuities, and yet they've never taken a look at what the Wharton School of Business has to say on annuities, or MIT has to say on annuities, who both recommend highly Americans, affluent retiring Americans, keep annuities for part of their portfolio. If you're talking to someone and have not read these reports and these studies and spent time, take everything you're hearing there with a grain of salt and keep on reading, because eventually you'll come upon the facts. Steve Jurich here. So we're talking about the 5 annuity don'ts, and one of them is don't overcomplicate annuities. They're not that hard as long as you know what it is you're looking for and you start separating out the things that aren't important to you. The most important aspect is know what you want an annuity to do. If you want fewer moving parts, lower fees, safety of principal, less cost, less risk, then it's going to be easy to find an annuity that's going to be a fit. Now, I will say that it's important not to just pick the first annuity that is principal protected and has many of those things we're just talking about, because once you get to that category, well, there's several hundred annuities to pick from, and you need to work with fiduciary, in my mind, who will actually take the time and show you how to rank the annuities based on their indexing capabilities, growth rate of the income base, how much the income will be later on, what's the fee for the income rider. There are annuities with no fee on the income riders. So I will re-emphasize that you can find an annuity today with no annual fees. 100% of your money goes to work on day one. You can even find annuities with a bonus of 3%, 5%, 8%, or 10% on your money. For instance, if you take out an IRA rollover from a 401k, you don't cash out your 401k. You go to an IRA, you place your annuity in the IRA, and the check is written from the current plan to the insurance company. So there are no taxes when that happens. Well, the fact is that you will have the ability to choose an annuity that could have a bonus match, just like you've been getting with your 401k, but you can get another match of 5, 8, or even 10% on your principal as it goes in. Think of that. That would actually pass through to heirs in many cases, but also will give you a booster shot for your income for the time when you start taking your income. And that income can be very strong in the range of 5 to 9% yield to cost, depending on your deferral period and your age. So don't overcomplicate it. Make sure you understand, I'm thinking about owning an annuity. Don't let the difference between a variable annuity, a fixed, an immediate, and a fixed index make you so upset you quit looking. It's easy. I'll show you how. I'm Steve Jurich. Thanks for joining us today for the 5 annuity don'ts. I highly recommend that you think over what we talked about, but I also want to welcome you and invite you to give us a call. We'll help you with the education on all these matters. At our place, education comes first, but what really comes first in our mind is you. We want to make sure you understand what you're doing and that you know what you're doing next and where your money's going to come from in retirement.
Mastering Money is presented for the general information and entertainment of a broad audience. No specific tax, legal, or investment recommendations are being made. Some guests may pay for airtime on Mastering Money. Past performance of all indices and assets should never be relied upon to predict future results. Thank you.
When you think about your retirement, do you worry that you might run out of money? That you might outlive your savings? Or that your investments won't last as long as you do? What if you live to age 100 or even longer, and your investments don't earn as much as you expect them to? Will there still be enough for you to live independently? What if there's a market crash during your retirement years, like there was in 2008 and 2009, and your investments lose 30% or 40% of their value? Will you still be able to withdraw the same income?
more income, smarter investments. Welcome back to Mastering Money on Money Radio.
Welcome back to Mastering Money on Money Radio, brought to you by IQ Wealth, where financial success is not only possible, but highly attainable. I'm Ken Morgan with retirement strategist and best-selling author Steve Jurich.
Hey, how you doing, everybody?
It's time now for the IQ Wealth Market Intel segment.
It sure is.
Well, here's a fact that surprises many people every year. Americans acquire over $200 billion in new annuities.
That's a fact.
In fact, LIMRA, the Life Insurance Research Marketing Association, stated at the end of 2016 that total annual sales have not fallen below $220 billion for at least the past decade.
Right.
Annuities have moved from being the red-headed stepsister in a financial plan to being a solid anchor at the center of many successful retirement plans. For those who want to worry less and enjoy life more, annuities can fit the bill.
That's right.
In retirement, both risk tolerance and time horizon shrink.
Mm-hmm.
In other words, you have less tolerance for risk and you have less time to make up for investment mistakes.
Correct.
Logically and typically, this results in the search for safer and more secure assets that can fulfill basic needs, mainly retirement income. The time for making up large losses and wondering where the money is going to come from to travel and enjoy life is long past.
Mm-hmm.
After two once-in-a-lifetime market crashes, two in a lifetime, in a time span of 10 years, smart people with a nest egg are looking to sidestep the next big crash with most of their money. Those who wisely move money to safety in retirement may still choose to keep a certain amount of their retirement capital in mutual funds for long-term growth, but for their core holdings, annuities are playing a bigger and bigger role. Retired investors seeking financial independence are more able to analyze things for themselves. They're not swayed by 30-year-old journalists writing stories knocking annuities. They're not swayed by aging, arrogant billionaires telling you that you don't need to keep your money safely tucked away in an annuity.
That's another guy named Ken. Yeah, when you know what you want, you look for it yourself and you think for yourself. It helps to have a skilled advisor at your side, but in the end, you are the one who makes a choice. What the next person thinks or what someone with a different agenda thinks, that's not important. What matters is you're having a real plan to reach your goals with the right tools and strategy to get it done.
Insure your income. Insure your outcomes. Invest to rest with purpose. IQWealth.com.
Learned that the largest percentage of the $220 billion worth of annuities each year are not purchased in the traditional sense of the word.
That's right.
There are no stores or websites where a person goes to buy an annuity. You can't go to Amazon, drop an annuity into a shopping cart, use your credit card, and buy instantly with one click. That's the only thing I think you can't do. There is more drawn-out process there. There's research, there's comparison, there's education.
Right.
It starts with the purpose of your money. Annuities aren't for getting rich. They're for keeping you rich and to avoid going poor.
Correct.
Studies show that most people over 50 worry about money almost every day. Annuities offer a viable way to reduce the worry. When you know that your cash flow will continue without fail as long as you live, and that income exceeds your expenses, you may not worry so much.
Yeah. When you buy car insurance, it costs you some money, but you can stop worrying about what happens when you get into an accident. Annuities are part investment and part insurance and should be part of the same conversation that includes those same topics: investments, insurance, long-term care, and the completion of a written financial plan.
That's why annuities are best acquired through qualified financial advisors with both an insurance license and a Series 65 securities license, which means a fiduciary standard is required of the advisor by law.
Mm-hmm.
The right advisor can take the time to understand your concerns and goals and can help you compare and make sure you're getting the right annuity to meet your needs. The right advisor will have your best interests in mind, and you should choose one who is qualified to go far beyond the annuity. They need to understand all of your investments. Agents who are not licensed as fiduciaries are more like salesmen than advisors.
Well, that's true.
A qualified fiduciary can guide you into preparing a retirement income model and help you choose which type of annuity is the best. They can help you figure out the right amount. You are still the boss, but it really pays to get qualified assistance.
Yeah, and typically there's no charge for qualified assistance when you're placing your annuity through the agent or advisor who's helping you. They get compensated by the life insurance company with no deduction from your account. It's a cost of acquisition of a new client for the life insurance company. In my view, only work with independent agents who represent at least 10 to 20 companies.
So, what's the number one reason annuities have become so popular in the 2000s? It has to do with the lack of pensions for baby boomer retirees.
That's right.
Back in the day, people retired with pensions. Today, not so much. Fewer individuals are covered by pensions, also known as defined benefit plans. Companies have switched to defined contribution plans, which are cheaper and easier to manage for employers.
Yeah, 401ks, 403bs, these are a lot cheaper to manage and oversee than actual pension plans that create defined benefits. That leaves you on your own to create a reliable, permanent income stream to last a lifetime for both you and your spouse. In the past, the decision on which year to retire was often guided by the amount of pension income that was guaranteed by a certain year. You got vested each year you stayed. A budget-conscious person logically retired when the pension amount reached the projected expense level during retirement. But without a pension, hey, what's the plan? How long will your money last? Do you know? You really should.
Insure your income. Insure your outcomes. Invest the rest with purpose. IQWealth.com.
Have a pension or your pension is not large enough, an annuity can add the pension dimension to your financial plan. Life insurance companies are pension providers. They hire full-time actuaries and accountants to distribute capital to annuity owners in mathematically determined amounts according to their ages, and they get audited by all 50 states. So you're not going to find a more regulated and more, in my view, safe and secure way to keep your money. Pensions are so valuable because they are designed to replace income from work. Well, annuities do the same thing. The number one purpose of an annuity is income replacement after retirement. While a person can take their chances on withdrawing income from risk-based mutual funds with no floor and no guarantees, more and more people are opting for having a floor under their money going forward and knowing their income will be there every month, rain or shine. Here's the deal. Every dream for retirement is only a dream unless it's properly funded. Annuities, pensions, and Social Security from the famous three-legged stool that might keep you sleeping better at night, well, having an annuity on there is one way to make sure that that stool is going to stand up. If you're missing one of those legs or one of the legs is too short, you will not have a smooth ride in retirement. The stock market will not go up forever. Where will you get your stability? You're not getting any younger. To properly fund your retirement dreams, make steps now to get a real financial plan built around real financial tools.
Get a customized portfolio from a real financial advisor and fiduciary. Make the smart call to IQ Wealth Management and retirement strategist Steve Jurich, one of Arizona's leading 401k rollover advisors and the originator of the Black Diamond Dividend Strategy. Steve can help turn your risky pile of mutual funds with unreliable dividends into a quality, diversified portfolio with built-in security and consistently growing dividends. Steve works with a team of independent tax, accounting, and legal professionals, including CPA Nick Stefaniak, attorney Richard Dwarnick, and PhD Doris Milton, to help you build a financial and estate plan second to none. It all starts with a free second opinion of your current financial plan, an upcoming rollover, your current plan for long-term care, or your current annuity. Find out why more listeners are turning to Steve for financial guidance and making the move to IQ Wealth. The meeting is free, but appointment times are limited, so call right now, 480-902-3333, and visit IQWealth.com and BlackDiamondDividend.com.
It's not what you make, it's what you keep that counts. And what keeps coming your way. Cut your fees, lower your taxes, increase your income. More for you and more for the people you care about most. That's the IQ Wealth Strategy. To schedule a complimentary review with Steve, call 888-310-1776 from anywhere. Stay with Money Radio. The journey continues.
You retire only once, but retirement strategist Steve Jurich and his team at IQ Wealth help people retire every day. Whether you're retiring early, late, or on time, you want a plan that's clear, easy to understand, and within IRS rules. You want cutting-edge strategies plus common-sense solutions that are proven, designed by an experienced fiduciary with your best interests in mind. When you meet Steve, you'll know right off. He wants you to succeed. As an authority in retirement income planning, he can answer your toughest questions, so fire away. For a clear financial plan designed to lower your risk and fees while increasing your income and net worth, meet with retirement strategist Steve Jurich in Scottsdale. There's no charge to meet, but appointment times are limited. Call 480-902-3333, 480-902-3333. Advisory services by IQ Wealth Management, a registered investment advisor. Custodian Fidelity Institutional. Call 480-902-3333 and visit IQWealth.com.
Insure your income. Insure your outcomes. Invest to rest with purpose. IQWealth.com. Insure your income. Insure your outcomes. Invest to rest with purpose. IQWealth.com.
I really don't know much about annuities. Are there different types?
There are different types, and that's the main thing you want to be aware of when you start shopping for annuities or you're listening to advice about annuities from other sources. There are 4 different types of annuities: immediate, variable, fixed, and fixed index. They each have very different capabilities, different attributes, and you need to find the right attribute to match your purpose. An immediate annuity absolutely just pays you an income and you lose the control of your principal. It's not a very popular option for that reason. Variable annuities is when you hear about annuities having a lot of fees. They do have a lot of fees, and your principal is not protected. Can have 3 to 4% in fees per year, as a matter of fact. Fixed annuities are just plain old like bonds. They pay an interest rate, and they might only now pay 2 or 3%. Not very exciting. There is the fixed index annuity, or what I refer to as the next generation fixed index annuity, which actually feels like owning a mutual fund where you can't lose money. But it goes way beyond being a mutual fund. The idea here is that you own your principal, that you have control of it. It can defer and grow, whether inside or outside of an IRA. You can enjoy, though, a guarantee of income for life for you and your spouse without having to worry about losing your principal. So those are the 4 types, and you have to be very careful when you're hearing negative things about annuities. Make sure you're hearing about the right category or right kind of annuity.
How is an index annuity different from an index mutual fund?
Well, we just talked about mutual funds, and that's what most people have owned, especially if they've owned a 401k for the last 20 or 30 years. Mutual funds are the most publicized, the most common form of investment in the world, actually. So people are going to have more comfort with them. When they first came out, people weren't necessarily comfortable with them. So if you're still looking into an annuity now as an alternative, thinking the market is too high, I don't want to lose my money, where can I put it? Well, you might then look at the next generation fixed index annuity, where you will be able to have your principal intact and you can benefit from upside moves of the stock market, yet you will never take a loss. The idea is with a mutual fund, you're going to go where the market goes. If it goes up, you'll be feeling great and you'll be thinking, wow, my future looks terrific. When that market falls, you get the full brunt of that loss. One of the things in the Kiplinger article I wrote was how a person retiring in 2007 on top of the world with an index mutual fund and lowest fees in the world, 0.14%. But by 2009, a $285,000 loss occurred on a $500,000 account. So you can have a low fee, but the cost of owning a mutual fund can be very high, especially in retirement when preservation is important. With an index annuity, that would never happen and does never happen. Your money is not directly invested into the stock market. The insurance company has a formula and a actual investment they use that can pay you a share of the upward movement of the index, and never do you participate at all in the downward movement. So that's a very key difference. Very important for retirement. And understand something, a mutual fund is not a plan. It cannot guarantee you a lifetime income. An index annuity can guarantee you a lifetime income for both you and your spouse.
It almost sounds too good to be true. Do I get all the upside of the market and none of the losses?
That's the most common question we get. I think right there, after people start to do their homework and research and do some comparison, they say, wow, how in the world could you get all the upside and none of the down? I didn't say you get all of the upside. You get a piece of the upside. The insurance company needs to make money. You want them to make money if they're guaranteeing your money. So the bottom line is this: you'll get a share of the upside, but you will not get any of the downside. And think about it, if the Dow was at 22,000 and we had a big decline, it fell back to 15,000. The beauty with the fixed index annuity is that you don't have to wait for it to come back to 22,000. First, you wouldn't lose a dime, and then you would make money from the move from 15,000 to 16,000. That would get it added on to your principal. What you make in an index annuity is actually interest, but the interest is indexed, and it's related or linked to the market index that we have in each different annuity. There are different indexes that they might use. Typically, it's the S&P 500. But it's not too good to be true. It's a real live, realistic adult holding that you get a piece of the upside, none of the downside.
I'm a retiring engineer and my spouse is a teacher. What is the main reason we want to own a next generation principal protected annuity in retirement?
Well, you know, a lot of our clients are engineers and teachers, people who really think for a living and use a calculator for a living. And the bottom line is that they're looking for a logical solution. They know the stock market is just too high to retire into and too uncertain. I mean, it could rise for quite some time, but then it could fall and it may not recover in time. And if you're withdrawing from a market type of holding, like mutual funds, and the market is falling, yet you still need your retirement income, you're not going to feel good about it, and you're going to see your balances decline dramatically. You don't want that happening just as you enter retirement. So the logical choice would be to find some form of asset where your principal remains intact. You can share in the upside of a market index, yet you have a guarantee on the income that feels like a pension. It is a pensionized income stream that can guarantee both you and your spouse income from now on, even if you live to be 110. The money will be there, the income will keep coming in. So the bottom line is you would have more income coming in than going out from now on, no matter what. The market does not affect the income. That's why a lot of engineers and teachers say, it kind of makes sense.
What is an income rider and why would I want one?
Well, the income rider is part of what the next generation moniker is all about. 5, 10, 15 years ago, there was no such thing really as an income rider in the form they're in today. An income rider simply takes your principal and then attaches a form of insurance contract to it, guaranteed by the life insurance company with reserves and completely monitored and regulated to make sure that you have enough money in that account and it's pooled with other investors so that you are going to have enough income from now on. It can be dropped from your annuity if you felt you didn't want it anymore. But 85% of all annuities now are coming with these riders. And you can't add it after you start. So it's something you want to really look into first. Don't wonder, do I need the rider? The rider is there to add that element of certainty and security to know that you are going to have another set of guarantees that will carry you all the way through your retirement for both you and your spouse and will guarantee that income.
Can an annuity help pay long-term care expenses later in life if my spouse or I need extra care?
Another great question. Some annuities, fixed index annuities, you won't find it in variable annuities, you won't find it in fixed annuities. Fixed index with income riders. There are several companies, and it's the minority, but if you look, you can find them, that will actually double your income, your retirement income, once you've turned the income on from the rider. Now you have an insured income stream to the day you die. Some companies will double that income if you cannot perform 2 out of the 6 activities of daily living, feeding yourself, etc. The same elements that you'd see in a long-term care policy. Once your doctor certifies that you can't do it, sends in a letter, your income would double beginning the next month. Why that's significant is most people will transition into a period before they'd ever go into a nursing home. You'd want to stay in your own home if you suddenly needed help around the house. And we're talking when you're out there in your 80s, late 80s, early 90s perhaps. Well, when that income goes up, there's no bills that have to be submitted or anything. That's just extra income coming into your household. But here's the thing, be careful, there are some index annuities that will double it for nursing home. Well, most people don't go into a nursing home, or if they do, it's only for a few months, and that's the end. If you want to create a really great retirement, you have to create a great retirement for now, for the middle years, and for that time. And that's what planning is all about. We always say in retirement, there are your go-go years, your slow-go years, and then your no-go years. Have a plan for all 3 phases, and that's where an income rider with an actual benefit for long-term care can really reduce your stress, but also increase your cash flow at just the right time.
Can I put my spouse on the annuity to receive an income for life, even if it is my IRA?
It's a great question. Most important thing about a fixed index annuity with an income rider is that on that rider, you can choose, not at the time of application, but down the road, whenever you start turning on that income. Let's say you're deferring for 4 years or 6 years. At that time, you can choose whether or not to have both you and your spouse on that long-term income guarantee. So it can be your IRA. The annuity is inside your IRA. You don't cash out of your other IRA and then just buy an annuity. That's not what's happening. Your IRA owns the annuity, and the annuity will allow you to put both you and your spouse as the income beneficiaries. That's a huge advantage over any form of mutual fund or managed money.
I've heard that annuities tie up your money and have lots of fees. Is that true?
Well, I'll tell you what, this comes back to that question about the 4 types of annuities. Very true with an immediate annuity. And a lot of times people will go into the AARP magazine or online and they're selling annuities from New York Life. Sounds great, says 7.2% return. That's an immediate annuity, be careful there. You will be handing over your principal to the insurance company. It's a fine insurance company, don't get me wrong, but the fact is that that's an immediate annuity. You lose all access to your money and can cut off your beneficiaries down the road. Most people would prefer to have control of their principal, and if something happens to them, their principal, every penny of it they don't spend, goes to their beneficiaries without any form of fee. That's why you want to make sure that if not having your money tied up is key, and for most people it is, you're going to want a deferred annuity. That would be either a variable, a fixed, or a fixed index. And running through those possibilities again, if you want your principal protected and control of your money, then a variable annuity is not the way to go. It's going to have too many fees, and then if this market gets crushed, your principal is going to get crushed. Your income would still be protected with the variable annuity, but I can tell you that it probably won't be as much income as you would get by keeping it safe with a fixed index annuity.
Does the insurance company keep my money if I die?
Wish I had $1 for every time I was asked that question. I'd be doing pretty well. The fact is there were old annuities that did keep your money when you die, and that even in the world right now, you go to AARP and buy one of those immediate annuities, that's what happens. If you pass away, nobody gets anything. Now, with an immediate annuity, you can choose to make it a joint immediate annuity, or you can have a 10-year guarantee along with the lifetime guarantee. But if you die in the 11th year, every dollar you put into that annuity is gone, stays with the insurance company. So if you've talked to somebody and they said, nah, I had a friend who did an annuity and the insurance company kept all their money, that's an immediate annuity. It's less than 5% of what people are buying right now. With a deferred annuity, every dollar you don't spend upon death goes to your beneficiaries. So we're talking there, the idea of insurance company keeping your money, if you're worried about that and you're hearing that, That's coming from an uninformed source who only knows about one type of annuity, an immediate annuity. It's not true with the other forms of annuities.
What is a surrender charge and why do they exist?
Surrender charge is going to be a part of just about every annuity you look at. You can buy annuities that don't have a surrender charge, but the surrender charge is there so that the insurance company knows that they can invest for the long term for you. Everybody knows that long-term investments pay more than short-term investments. If you want just pure liquidity and you need to have your money available all the time right now, that's going to be a money market decision. You just want to own money market then. Will a money market guarantee your money for life and give you an income of 5 to 9% depending on age and deferral period? No, it won't. That's a different type of asset for a different type of purpose. The money that you allocate to an annuity is for long-term planning. The insurance company needs to have the money available for you 5 years from now, 10 years from now, 15 and 20 years from now. They need to make real, strong, long-term investments. If you leave too early, they've already made those investments. They have to have a way to protect themselves. And that also keeps the entire annuity pool stable. Many people say, oh, how can they guarantee all this money? It's because if people have surrender charges in the earlier stages, no upfront fee, no annual fee, but if you leave too soon and you withdraw more than 10%, because there's no surrender charges up to a 10% withdrawal annually, but they have to have a way to keep their entire fund stable. And that's what surrender charges are all about. That allows them to not have to charge you an upfront fee. That allows them to not have to charge you an annual fee in a fixed or fixed index. Variable annuities, they somehow have both surrender charges and annual fees. So if you're looking to keep your fees low, your security strong, and your income long, you want to look to an annuity and be aware, just allocate the money that you're not going to need to go out and buy groceries with. Because while you have decent liquidity with a fixed index annuity as an example, you can withdraw up to 10% of your money annually penalty free. Any amount over that for several years is going to be subject to a surrender charge. One day the surrender charges all go away. So it's a way to keep your fees down, not a way to increase them. And if you hear otherwise, it's coming from an uninformed source.
How safe are annuities?
Great question, because the number one reason you would move to an annuity with part of your capital is to get it out of harm's way while still solving the problems that you need to solve in retirement. You want to preserve your capital, you want lifetime income. Where are you going to go to get it? Well, stop and think about it. Back in the 1930s, 9,000 banks failed. Check your history book. It wasn't the U.S. government that bailed out banks in the Great Depression. It was actually legal reserve life insurance companies who stepped up, lent money back to the banks to get them back in business again. Banks are run a little bit differently from life insurance companies. They're a little loose with the money. A bank, if you come in with $100,000 today with a bank CD, they can lend out $900,000 on that money. Life insurance companies can't do that. They must maintain stipulated reserves over and above their actuarial obligations. That's why you see companies that are over 100 years old still offering, like these next generation annuities. They come up with new products, but they insure the money the same old way. They have 50 state regulators. Any company doing business in 50 states has 50 state regulators breathing down their neck, and they have to produce public reports for all of them. They can't hide. And so the bottom line is, if you're looking for a reliable place for your money from institutions that have made it through 2 world wars, stock market crash of '29, the Depression, 9/11, and 2008, didn't need a bailout in 2008, then you look no further than legal reserve life insurance companies. Recently, we had a guest from a $53 billion life insurance company who came on the air on our show, Mastering Money on Money Radio. And I said to him, how can you assure people that their money is safe? What is the most important aspect of the way that you guarantee money? And he said to me, Steve, here's what I'm most proud of. If everybody who owned an annuity with us all wanted their money all on the same day, we could give it back to them and we'd have money left over. Try that at your local bank or with a mutual fund.
How are you, the agent, compensated? Do I have to pay you a fee?
You know, I get that question, and it really is gratifying because typically we're doing a complete financial plan for people and we're not asking them to write a check to us. We're going to get compensated by the life insurance company, much as, say, manufacturer's rep would get compensated. The life insurance company is very willing to give up part of their profit to have agents, independent agents, that they don't have to buy health insurance for or buy an office for or anything like that, bring them business. Many of the life insurance companies are in Des Moines, Iowa, or in Nebraska, or in Kansas, the heartland. The fact is that they don't want to go hiring 3,000 employees in all the different states and monitor them all the time. They have a licensing method where you're a manufacturer's rep. They decrease their profit for several years to cover that. But the fact is, we get compensated, and because I know at our firm, because we're being compensated, we don't double dip. There's not a fee on top of that for a life insurance or annuity product. So it's a very convenient way for you to come in and keep your fees down, and you still get to work with somebody who's happy because they're being compensated. Now here's an important point though. 100% of your principal goes to work right away and is not reduced by compensation for anybody. So you don't ever feel the impact of our getting compensated, yet you reap the benefit.
Does the annuity come with upfront fees?
Again, very important aspect because most people think the worst about an annuity if they're not completely knowledgeable on all aspects. The biggest important thing to remember about an annuity and about the company, they're not trying to gouge you. They're trying to provide a competitive financial product that you and your family can rely on and count on. That's the competitive advantage over a mutual fund or a REIT or something like that. So the bottom line is there are no upfront fees and no annual management fees in a fixed index annuity. Even in a variable annuity, there's no upfront fee. You'll get the annual fees. But take that to the bank. You choose the right annuities, you will be paying 0 upfront fee, and with some annuities, 0 annual fees. And those are the ones that we try to find for our clients and fit them into their financial plan.
I have a 401k that I want to protect from market losses and maybe take some income like a pension. Can I move to an annuity without taxation?
Yeah, that's a very good point too. We have a lot of people who come to us that have changed jobs. They might be in their 40s or 50s, and they change jobs, leaving behind an old 401k where they were. Well, that old 401k can be transferred to an IRA, and that IRA can be funded with a next generation, low-cost, principal-protected annuity with an income rider. Wise choice. Also, some people will, who own a 401k now, can transfer, if they reach a certain age, into an IRA, self-directed. They don't shut down your current 401k. You can still continue to contribute to your current 401k. You just now own separately without any taxation involved in the transfer. A separate IRA that is actually doing another job besides growing your money in the 401k. You now have a separate IRA that is contractually guaranteeing your money and that you're building up a pension-like income for you for the rest of your life, along with those index gains as your potential. So it's a way to diversify, and it's a way to really, especially if you have an old 401k just sitting there, it's a great move to start getting your money safe and out of harm's way with that one while you continue to contribute to your current 401k.
I have an IRA that I want to protect from market losses. Can I move to an annuity without taxation?
Another great question. Typically someone that comes to us already with an IRA transfer from a 401k, 403b, or 457 plan is sitting in a large IRA. And let's understand something. A 401k or any other retirement plan and an IRA are garages. They are not the investment themselves. So you're taking vehicles out of that IRA garage and driving new vehicles into that IRA garage, and that vehicle can be a guaranteed annuity. You don't cash out of your IRA and go out and buy an annuity. That's not at all what you're doing. Simple paperwork, we do it in our office, easy to do, and you simply transfer funds through paperwork from your current IRA into a new IRA at the life insurance company, and they're your IRA custodian registered with the IRS. Simple procedure, we do it every day.
I have a 403B that I want to protect from market losses. Can I move to an annuity without taxation?
All right, so this question relates to some of the others. 403B is a form of retirement plan. The types of retirement plans are 401k, 403B, 457, and even TSP. The 403B is typically for teachers, for nonprofit organizations, and some hospitals. And so the bottom line is it has the same transferring procedures of any other retirement plan. And typically you go to your HR person and they might have a form that you fill out and then you deliver to us and we'll take care of it from there. Also though, more and more 403Bs can be transferred online, especially with say Fidelity and Vanguard. So it's a very simple procedure, same as a 401k, same as a 457 or TSP plan. All are very simple procedures to make the transfer and no taxation is involved in that transfer.
How can the insurance company afford to guarantee my income for life?
Well, it's a great question because if you went to your bank and said, hey, can you guarantee my income for life? Well, they couldn't do it. If you went to buy a mutual fund, you aren't going to find one that can guarantee your income for life. Only life insurance companies, not health insurance companies or property and casualty companies. Life insurance companies can guarantee your income for life because that's what they're built to do. That's the business they're in. They are the guarantors of delivery of money to the future, either in the form of a life insurance policy or an annuity with income for life. The way that they can afford to do it is they make a good return on their money, but also it's an actuarial pool. Everybody who goes into an annuity is not getting into it to get out of it the next day. They're getting into it to protect their money for life. Not everybody dies on the same day. So the bottom line is the insurance company is making a great return on all the money in the portfolio. Let's say it's a $50 billion insurance company. And they are long-term investors, so the compounding continues to grow. Meanwhile, people are only taking a part of that money out annually. So because everybody doesn't need all their money out at once, and by the way, some life insurance companies, fixed index or fixed annuity companies can return everybody's money all at once if they had to. They don't need to. The life insurance contract is different from an annuity contract. An annuity contract, you're asking for that insurance company to pay you an income for life. They must keep actuarial reserves to do that, and the actuaries they hire disperse the money in the amount that will take care of everybody, and those calculations are audited, and that's why you can be sure that you're going to get your money from now on.
My broker doesn't think it's a good idea. Why?
Gee, what a surprise. The fact is that most brokers do not spend their time studying an annuity. It's a sideline for them at best, and what it really is, though, is opportunity cost. I mean, I'm not knocking anybody's advisor. They're all great. They're great people. The fact of the matter is, though, they're also people. And if they're losing an amount of money to manage that's giving them, some income right now, their first inclination could be, hey, whatever it is, it's not a good thing. But especially annuities. Brokers don't like losing customers to annuities that get into their 50s, 60s, and 70s, but it's going to happen. More and more people want certainty and safety and income more than they want the opportunity to become multi-millionaires with their money. So the fact is your broker, if they are recommending it and they're recommending me, that's a big surprise because typically they believe in their own product and they believe in themselves. And the fact is they're trying to grow their assets under management. When you're taking assets away, they feel like it's their money. Let's remember something, it's your money. And your broker may not think it's a great idea, but I'll be happy to talk to your broker for you, and we can ask the questions on a 3-way telephone conference call, and we can make sure that we're getting the right decision for you, because this is your life and this is your money.
I heard a grumpy old billionaire on the internet say that he hates annuities and thinks I should too. Why is he saying that?
Well, here's another example of somebody who is losing clients to annuities as they start to get a little bit older, a little bit more mature. You're not old at 50, you're not old at 60, you're not old at 70, but you know that your time span for starting all over again with your money is not there anymore. You don't want to backtrack. If you've accumulated enough money to retire on, what's going to protect that money? You get another 50% decline, then what? If you look at this source of that, I hate annuities and you should too, it lost money in 2008. The market came back, but that had a lot to do with the Federal Reserve pumping money back into the system. Will that happen again? I don't know. But if you're looking for the certainty, you want to go in a different direction. As people age and this person loses accounts, that has got to be the reason why he's spending $3 or $4 million a year on television and internet advertising saying that. Otherwise, what would be his motivation? If it wasn't bothering him, he wouldn't even bring it up. So bear in mind, this is your money, this is your life. You are a very smart person. Use your brain when you're starting to decide where you're going to put your money.
What's the difference between a variable annuity and a fixed index annuity?
Very big difference. A variable annuity is always going to look pretty good as the market is rising. And when people make a decision to buy a variable annuity, they maybe have a comfort level with mutual funds because they've been investing in them for 20, 30 years or more. So they look at a variable annuity because they've started to say to themselves, hey, maybe I should look into an annuity. What the heck? The first one they might look at if they walk into a bank lobby or talk to a broker or a securities firm, they may offer one or two different variable annuities. And they know that it's going to be an easy sale for them because they're going to see the same mutual funds inside the variable annuity that they see just in their mutual fund accounts. The problem, though, is when you're making an annuity decision, is it all about making more money or is it more about preserving money, preserving death benefit perhaps, but also creating more income and having less stress? The goal is to have more money coming in than going out from now on, no matter what. That's what an annuity is designed to do. Do you want to pay 3 to 4% a year in fees? With a variable annuity, you will. You'll have your mortality and expense charge, that's 1 to 1.5%. You'll have an income rider charge, that'll be 1 to 1.5%. We're up to 3. Then there's also the sub-account management fees. All those mutual funds, that's another percent. That's 4% a year. A $300,000 annuity would have $12,000 a year in fees. Think about that. In 10 years, you've paid $120,000 in fees. So the person who hates annuities and thinks you should too, he and I agree right there. Variable annuities. Fixed index annuity, the next generation, some with uncapped strategies, there's zero management fee. And there are several plans now that have zero rider fees. So you're no fee up front, no annual fee, and you have all the benefits you're looking for. Fixed index annuity preserves capital, pays you your income, and gives you less stress and less worry about markets. So it's up to you, but in our view, in the view of our clients, for the purpose of what an annuity is designed to do, you're not ever going to make money with a variable annuity if you're going to be paying 4% a year in fees from now on. With the fixed index, you'll do well. You're not going to make $1 million overnight perhaps, but you're going to keep your money safe. And we think that with the purpose of what an annuity is designed to do, that the fixed index annuity typically is a better choice.
What's a hybrid annuity?
Great question. A hybrid annuity, actually the term hybrid annuity was used more back 5, 6, 7 years ago. When I wrote Smart is the New Rich, people were using the term hybrid annuity for the fixed index annuity because it combined the elements of a way to benefit from the upside of the stock market, yet have the safety of a fixed annuity. So blending those attributes is like a hybrid. I still like the term, however, the proper term is a fixed index annuity, but you'll also hear terms like new generation, next generation, hybrid. They're all the same annuity type. Don't get confused by these marketing nicknames. That's all it is. But a hybrid annuity is a nice way to think about what a fixed index can do. Now, in recent years, there has been a security, a variable annuity, called a hybrid annuity. And that's a totally different thing, and you want to be careful with that. Also, the term equity index annuity. There is a security, a variable annuity, where you can lose money. It's got your principal at risk. So the correct term is fixed index annuity. Equity index annuity is typically now a variable annuity. A hybrid is simply a nickname for a type of annuity that guarantees your money, yet has some access to the upside. And so it's just a marketing nickname, but I wouldn't get hung up on it.
I've heard the term equity index annuity. Is that the same thing?
Right. An equity index annuity, that term was used for many, many years when fixed index annuities first came out. Going back to 1996, that's when this form of annuity came out. It was referred to as equity index annuity because of the way the sales of these products took off, because I mean, it really started making a dent. And the big securities firms said, hey, wait a minute, you're going to give them a share of the upside, none of the downside. And there started to be an exodus into these annuities. Well, the securities industry said, we've got to do something about it. We can't have them using the word equity index. It sounds too good. So they said, you're going to have to start using the term fixed index annuity. So equity index annuity, if you hear somebody using that term now, it's typically an advisor who is not up to speed on what the annuity terminology is these days. And I mean, they're 5 years behind. The term equity index annuity no longer applies to fixed index annuities. So all I'm saying is, if you're hearing that term, that's a sign you're listening to somebody who's either misinformed or less informed than they need to be to give you proper advice.
I've heard you talk about lifetime income equivalent to 5 to 9%. Really?
Absolutely. This is the thing where in the old days of retirement planning, and I say old days, I mean, the 1990s, 1980s, people were getting 5, 6, 7, 8%, even 9 and 10% on 10-year treasury bonds. Many bonds paid 6 to 8%. So back in those days, if you were retiring, many people got completely out of the stock market and put all their money in bonds. That was done routinely. And if you had $500,000 and you were getting 8% on your bonds, $40,000 a year back in the 80s and 90s, take that plus your Social Security, pretty nice retirement. Today, 10-year treasuries are paying in the 2.5% range, and sometimes they're even paying under 2%. You can't retire on 2%. So the fact is, it's pushed a lot of people into the stock market, and as long as the stock market is doing well, you can feel like you're on track, but you have to know you're on track. And so the benefit of a fixed index annuity with an income rider that you defer for a while is you can build up a guaranteed lifetime income. Let's say on $500,000, thinking of an example we did recently where a person deferred out to a point where their lifetime income was going to be $48,000 a year for life from that annuity. Trouble-free, not worrying about markets. If it was $50,000, that would be what? 10% equivalent of what you paid in. Put in $500,000, you're getting $50,000 a year for life. At $48,000, that's still just under 10%. That's a little bit longer deferral, and it depends on your age as well, because the life insurance company will pay more as you get older, right? If you're much younger, you're farther away from the time where they're not going to have to pay you anymore. So the bottom line is that if you're looking for a way to make sure that you can get the same type of income you once could have gotten from bonds, I don't know of any other place to go, especially with this type of safety, than a fixed index annuity with a income rider that can guarantee the equivalent of a 5 to 9% income for life, depending on your age and deferral period.
How liquid is the annuity? Can I withdraw from it without penalty?
Very important point comes back to the question of the different types of annuities. Again, with an immediate annuity, there's no withdrawing. You've handed your money to the life insurance company. But with deferred annuities, variable, fixed, and fixed index, typically you can withdraw up to 10% per year from that annuity penalty-free. Theoretically, in 10 years, you could have all your money back out. But your money is really not tied up. You could take all of your money out the next day if you wished. You could take it out the next year or two. It would be subject typically to surrender charges. So the bottom line is most people don't take out more than 10% per year from their annuity. And more it's part of an overall financial plan for retirement where that income amount is really part of the plan. So you're not finding yourself withdrawing. We set up several buckets. We have your cash bucket, your fixed income bucket where the annuity goes. You separately have a growth bucket and then a insured outcomes bucket. Because we have you properly allocated, you're not having to tap into that annuity prematurely. And so the bottom line is, yes, you can. It's liquid enough. You could cash the whole thing out if you wanted to, if you got the right type of annuity. But typically, you're not going to need to take out more than 10%, so you'll never pay a surrender charge if you're properly allocated.
What about required minimum distributions? How will it work if I'm using an annuity from my IRA?
In financial planning, there are milestones you hit. 59 and a half is when you can finally take money out of an IRA or an annuity without paying penalties to the IRS. 62, you can start collecting Social Security. You could also get a reverse mortgage. 70 and a half, the year that you turn 70 and a half, all of your IRAs are subject to required minimum distributions. And the percent that you need to take out from your account every year, that percentage goes up every year. Creates a great deal of stress because if you don't take enough out, the penalty is 50%. That's the stiffest penalty in the entire IRS code. So people stress out about it. One of the things that we do for our clients is set up a income stream coming out of your IRAs by utilizing an annuity that covers your RMDs and oftentimes can cover RMDs that for other IRAs because there's a rule called the aggregation rule. Let's say you have 4 different IRAs. One of them is an annuity and the other 3 are in mutual funds. We may be able with the income rider to cover your entire RMDs for the other IRAs as well. And now you can take away the stress and the worry. You've got your required minimum distributions on autopilot. That's something we like to do for our clients. We like our clients to feel secure and reduce their stress, reduce their costs, and reduce their taxes any way we can.
Insure your income. Insure your outcomes. Invest to rest with purpose. IQWealth.com.